Hi, I'm Keith McCullough. Welcome back. After a couple days of vacay, I'm going to give you an update on where we stand. I've heard a lot of people talk about the market and what the market's doing, but the reality is that the market's doing what it's doing. So we're going to give you 10 quick slides or pictures on reality. The main reality that I'm going to focus on is our top global macro theme here in the first quarter at Hedgeye, which is, of course, inflation accelerating. So the first thing really that you need to think about when you think about inflation is the currency. What is the purchasing power of your currency? So again, as opposed to listening to what the government's telling you about inflation or this person or that person, just watch what's in your wallet. What is the value of the US dollar? So that's really the first point on inflation accelerating. As you can see in this slide, the dollar is actually down now for the third consecutive week, including this morning. So again, that is not a good thing. That is a leading indicator for what? The cost of things that you buy on the next slide, which is, of course, commodities accelerating. So again, one of the most obvious or implicit ways to see inflation accelerating is in the CRB index. Now, this is a basket of 19 commodities, and no, it's not all weather-based. So again, up 7.9% for the year to date. That's obviously versus the Russell 2000, down a full 3%. So again, commodities, or if you're long inflation, that's outperforming pretty much anything here in the U.S. in terms of the major indices. Now, finally, on inflation accelerating, you can see some of the most exciting stuff like natural gas. Now, natural gas, people say, it's the weather, it's the weather. Enough about the weather, all right? Okay, come on, man. I mean, this, again, is it the weather in Venezuela? Is it the weather in every other country that is rioting based on food and energy inflation? Obviously here, this is a local commodity, and it's up a lot for the year to date. But as the weather turns, I can guarantee you this. Natural gas isn't going back to where it was at the start of the year. Up 47%. That's a huge consumption tax. Now, let's roll into that in terms of how that looks in terms of the other stuff. What does inflation do? It slows growth. What does really, really well when growth slows? Gold. Exactly. Now, look at gold. I mean, look at that. There's no weather in gold. Last I checked, I mean, there are no weather traders in gold. Enough about the weather already. Look, up 9.3% for the year to date. Big time performance versus the S&P 500 versus pretty much anything on the growth side. So again, if you're long slow growth and inflation, you're really nailing it. Now let's look at something else. What's another way to be really long of slowing growth? Utilities. Look at that. Utilities. Who's not long utilities? I mean, obviously not everyone's long utilities because they were the worst performing sector in the market last year. Why? Because growth was accelerating last year. So now growth is slowing as inflation accelerates. And the best performing sector in the S&P 500 for the year to date is in fact utilities at up 6% for the year to date. Now finally, if you're not levered up long enough of the things that the Federal Reserve really wants you to buy. So again, they'll burn your currency, but they won't call it a policy to inflate. They'll get commodity inflation, but then they'll say there's no inflation. And they want you to go buy another house or something like that. So house flippers on A&E, go buy that. Come on, I mean seriously, but in the marketplace, up 7.5% for the year to date for the REIT index. Again, not to be outdone by gold, but again, gold is outdoing that. The reality is that people are going back to the playbook. When U.S. growth slows, people fundamentally believe that the U.S. government, particularly the Fed, is going to print, burn the currency, which inflates asset prices. This doesn't mean that housing demand is going up, by the way. What's been interesting this year is that interest rates have been falling, another reason why gold is rising. As interest rates have been falling, mortgage demand has been falling at an accelerating rate. That is going to drive the mother of all doves just batty. Janet Yellen doesn't like that. That's not supposed to happen. But guess what? Housing demand is now tracking at its post-crisis lows. MBA purchase applications, which is what we look at week over week, down 6% this week versus down 5% last week. I mean, this is a train wreck. Never mind REITs being up for the year to date because people have to chase them. Just look at that for what it is. So in summary, you can see inflation accelerating. That's on the right side of this chart. You can see it, gold, utilities, REITs. Inflation accelerating also means that you're going to get incremental consumption growth slowing, which you can see on the left side of the chart. That's XLY, consumer discretionary stocks. XLP is consumer staple stocks. And XLF are the financials. Now, we'll just rattle off those charts quickly for the year to date, just because you need to see what's actually happening. As you can see here on the year to date for consumer discretionary, just awful. I mean, if you're long in consumer discretionary, shame on you. You should not be, given everything that I've just said. And this is primarily why I think our short ideas are working out so well. Potbellies or Cheesecake Factory, any of these consumption-oriented assets. So again, Rate of sales is slowing, costs are rising. Very, very bad for these companies. Again, consumer staples, you can see it the same thing. One of our favorite shorts in consumer staples has been Coca-Cola. So again, slowing sales growth and rising costs is not good for consumer staples, and it's certainly not good for Coke, irrespective of Mr. Buffett owning it. Now, financials. This is the one that matters the most from here because, again, financials are down for the year to date, down more than the S&P 500, and I do think that from here, to get the financials right, you're most likely going to get the market right. Now, obviously, if you look at the market overall, there's a lot going on here. If you're long utilities and short consumer, you're absolutely killing it. But the financials are kind of wedged in between here. And I don't think that the financials can work unless interest rates break out to the upside and growth reaccelerates to the upside, which would be very difficult to do if, in fact, you continue to have down dollar and inflation accelerate. So that's it. That's the update. I'm back from the vacay, ready to work. And if you have any questions, I'll be on Twitter. @Keith McCullough is where you can find me.